Okay, let's get started. I apologize for running just a tad late this afternoon. I had a little bit of trouble getting a graphic into the report up on the website this week, so I'm going to try and refresh that, and there should be a chart of biomass-based diesel production in the biodiesel section of the report by the end of the day, hopefully. Anyway, welcome to the March 22nd version of the Fats, Fuels, and Oils webinar. This week, we're going to talk a little bit about choice white grease, and then we'll talk about biofuels, and then we'll take any questions that anybody has. Next week, we're going to do something a little bit different. We're still going to have our usual call, but I'm going to give sort of a little short presentation on the upside price risk for soybean oil. And then David Becker is going to join us, and he's going to talk about some risk management solutions that you can use to hedge risks in commodities that don't necessarily have associated futures contracts. So typically, the way that people have hedged things like choice white grease are there's some correlation between the price of choice white grease and soybean oil. And so you use soybean oil futures to hedge your choice white grease price risk. And that generally works until it doesn't. And when it doesn't is usually the time that you need it to work the best. And so we have some ways to more directly hedge that that price risk and avoid that slippage in the correlation. And those correlations over the past 18 months have really broken down. One of the ways that we used to forecast the prices for fats and greases is we used to look at the percentage of the choice white grease price or whatever that was represented by the price of soybean oil or the price of corn, depending on exactly which commodity, and based on that range kind of project prices. Well, last summer all of that kind of went out the window because those relationships really broke down, which kind of underlines what I'm saying about the idea that those correlations work until they don't, and when they don't, it's kind of usually when you need them the most. Anyway, we'll talk more about that next week. This week, let's get into what's going on in choice white grease. What you've seen is choice white grease prices fell pretty sharply. I think they dropped by 8 cents over the past week, and that is sort of different than a lot of the other vegetable oil or fat and grease prices. We've seen a little bit of weakness in some of the commodities, but not any of them have dropped by as much as choice white grease did over the past week, and that's primarily due to the outbreak of bird flu, or this year's outbreak of bird flu. There are two types of bird flu, and bird flu is kind of always around. The migratory birds are infected with bird flu, and as they fly back and forth across the country, their droppings tend to spread the infection. And there's sort of a low pathogenic version of it and a highly pathogenic version of it. This year's outbreak is unfortunately the highly pathogenic version of it. It was first detected at the end of February in Indiana, and since then it's resulted in the culling of 12 million birds. And so since choice white grease is used, since a lot of choice white grease is used for animal feed, the impact in chickens and turkeys tend to eat a lot of animal feed just because there's so many of them. The impact on choice white grease has been more significant than it has been on some of the other fats and greases. So what does this mean going forward? Well, it really depends in part on how bad this outbreak is. So the last time that we had a really bad outbreak of bird flu was in 2015. And that year, I think they culled 40 million birds, or maybe a little bit more than that, maybe 40, 43 or 45 million birds. Um, that outbreak also started a little bit later, and it started in Minnesota. The bulk of the birds that were culled that year were culled in Iowa. Um, and Iowa is obviously a large producer of chickens and turkeys, but the main or the most intense producing region in the country is really in the southeast. And so while you could say on one hand, Indiana, and that outbreak started in Minnesota. So on one hand, you could kind of say the outbreak here is in Indiana. That's a little bit further away from Iowa. On the other hand, I think you could say that it's significantly closer to the southeastern portion of the country than Minnesota is. And so it, right now, I think it's hard to really kind of say with any confidence exactly how this is going to go and what the impact is going to be. To start, what we did is we were predicting that feed usage for choice white grease would be 425 million pounds for 21-22 for the 21-22 marketing year. We've cut that by 25 million to 400 million. That's still 20 million above what we estimated feed demand was last year. And so there could be another significant cut in feed demand, or a more significant cut in feed demand if this outbreak is as bad as it was in 2015. Right now, we have offset the reduction in feed demand with an increase in the demand, the other demand, which is mostly chemical, but a couple of other things in there as well. We've increased that demand by 25 million pounds to offset the decrease in feed demand. And so our balance sheet hasn't really changed. Non-biofuel demand hasn't really changed that much. If we have to make a more significant cut in feed demand, I think it's going to be kind of hard to stick it into that other category, because it's not like if choice white grease is cheaper, that the chemical industry is all of a sudden going to use a lot more of it. And so this could be a situation where prices, at least for choice white grease, could come under pressure even as much of the rest of the sector remains steady, or potentially even moves higher. We didn't really change our price forecast. I think I changed my price forecast for March. I lowered it a little bit, but I left the rest of the price forecast basically unchanged. And you can see from the chart that we are expecting prices to rise above 70 cents and above 75 cents really during the second half of 2022. And so I think there's probably some significant price risk there. At the same time, I think that that price risk is probably limited. And while I don't necessarily think that you can stuff more choice white grease into the chemical industry, I think you probably could stuff more choice white grease into the biofuel industry. And so ultimately, that's probably what will happen. If I have to cut the feed demand more, I probably will start to put that demand into biofuel feedstock demand. And so I don't know that I can see really cutting prices or price forecasts much below 65 cents. And it may even be the case where we get a little break in prices right now, but then whatever demand is lost to feed quickly gets taken up by the biofuel industry, and prices come right back. So I hate to be really sort of non-committal on all of this, but it's a situation that's really sort of hard to predict with any confidence. And so we're going to kind of stay the course right now, but I would expect that we probably will be making some changes in the coming months as we start to know more about what's going on. Typically, bird flu outbreaks end at some point in the spring because the migratory birds are have returned to wherever they nest for the summer, and they cull a lot of birds when ever there's an outbreak. Essentially, if there's an outbreak at a commercial facility, they cull all of the birds at those commercial facilities to try and stop the spread of the disease. And so at some point, because the migratory birds have already moved through, and then you've culled all of the birds that have the flu or possibly could have the flu, it tends to the disease tends to, or the outbreak tends to end at some point in the spring. So I think that this probably is going to be a relatively have a short-term impact on feed demand, which is another reason why we're kind of being relatively cautious in the changes that we make. But nevertheless, it could really have a significant impact on demand, and it can potentially on prices as well. All right, that's really all I have on choice weight grease this week. For biomass-based diesel, as I said earlier, there will be a chart up here that will show the biodiesel and renewable diesel production for February. We just got those numbers from the EPA this past month, and production was generally up from January, but not compared to sort of like December or whatever. And it looks like 2022 production will follow the more typical seasonal path that we usually see, or that we have seen most of the time, excluding sort of the past 2 years when people didn't know what the mandates were. Based on a couple of things, well, what I should say first is, despite the increase, the numbers still came in, or I guess in part because of the increase, both biodiesel and renewable diesel both came in pretty significantly above where we were projecting production to be. That's just mainly due to the fact that we kind of take a seasonal trend for our monthly forecasts, especially in January and February. And over the last 5 years, that seasonal production has been significantly lower than it has been this year. So production came in well above what we were expecting, but despite that, we didn't really make any changes to our production forecast. We really just kind of smoothed them out over smooth the reduction in the other months, because this month was higher than we expected. We took some out of the other months to keep our annual numbers unchanged. And right now that still seems like it makes sense. However, we also updated our forecast for ethanol production based on the latest short-term energy outlook from the EIA. And that cut our forecast for ethanol production by about, I think, cut it by about 200 million gallons or so. That makes the shortfall from what we forecast ethanol production to be relative to the 15.25 billion gallon implied mandate to be even larger. And so I would say that if there is a change to our annual forecast that's coming up in the coming months, it probably is higher. That gap now is pretty close to 900 million pounds or so, which implies, I think, about 560 or 580 million gallons of additional D4 or D5 production that's needed to fill that gap between between the ethanol mandate and the overall mandate, and really it's just to fill the overall mandate gap. Um, that's about 100 and whatever, call it 75 million gallons above the 400 million gallon um, increase over the biomass-based diesel mandate that we already have built into our forecasts. And so there's a potential change there, but at this point, it's not significant enough that I really want to go ahead and make that change. I want to get out of the January and February months and see what production looks like coming in March and April before I really start to make that change. We'll get new short-term energy outlooks and gasoline demand projections from the EIA as well that may change our ethanol production forecast. And so all of those things could change in the coming weeks and months. And as a result, again, we're going to be a little bit more cautious about the changes that we make, primarily because as an analyst, you don't really want to significantly raise production one week and then significantly lower it the next week. Sometimes you have to do that, but you try to avoid that as much as possible. And so I would rather be a little bit cautious and get a little bit more data before I start to really change those 2022 renewable diesel and biodiesel production forecast. On biodiesel, the average daily production was a little bit below what we saw in December, but it was above last year, and it was significantly above what we saw last year, although down from 2020. And so what I think that really means is that yes, we are starting to rationalize the biodiesel capacity. And I think in the past couple of months, we've talked on this call about the EIA numbers and how they kind of were steady and even rose for a bit in 2021, but then started to come down relatively quickly during the last couple months of 2021. That seems to, at least from an average production standpoint, that seems to have stalled. And that kind of matches up with this idea that there is this big gap between what ethanol production will be in the implied ethanol mandate. And that gap will need to be made up, at least in part, by biomass-based diesel and renewable diesel production. If that all is true, then I think what you would expect to see is sort of average daily domestic production of biodiesel remaining kind of steady or maybe slowly moving lower throughout the year. And that is kind of what we've seen, at least so far in the first 2 months of the year. And so if that's the case, and we do need to add more to our biomass-based diesel production forecast to close that gap between ethanol and the ethanol mandate, ethanol production, and the ethanol mandate, we probably will shade it a little bit more to biodiesel rather than renewable diesel, in part because our renewable diesel forecast, if we look at our renewable diesel projection relative to capacity utilization, we're already pretty close on capacity utilization. And so unless there's going to be a new plant that we don't know about, or a plant that we think is going to open in 2023 is actually going to open in 2022, unless there's some change like that, the increase in production probably is mostly going to have to come from biodiesel rather than from renewable diesel. So to the extent that we're going to change our forecast, it probably is going to be an increase in our biodiesel forecast for 2022 rather than an increase in our renewable diesel production forecast for 2022. What that means for feedstock demand is really not that much. The difference in sort of soybean oil's percentage of total feedstock demand relative to for biodiesel relative to its percentage for renewable diesel is pretty close, at least as far as we can tell from the data that we get from CARB, which is really sort of the only peek into the actual feedstock demand for renewable diesel production relative to biodiesel production. So I don't think it'll shade the demand one way or the other. If we add to biodiesel relative to renewable diesel, I think it's just a matter of where the credits are generated. All right, with that, let's look at gross margins. All right, and so last week, gross margins for biodiesel rose slightly. They rose about 5 cents a gallon to a 1 cent profit, including the value of credits, while renewable diesel dropped about 19 cents to just below $2 a gallon. It seems like renewable diesel probably is going to stabilize around $2 a gallon, at least in the short term. And biodiesel is going to stabilize around flat to little bit of profit, little bit of loss, somewhere in there. At least that's what it's been so far this year. We do still expect margins for both to come under pressure as we move through the year until we get to this, until we start to rationalize biodiesel capacity. However, if that additional demand is really there and we really do need more biodiesel production than we're projecting right now, then that probably also implies that biodiesel margins will probably be a little bit stronger than we are projecting. Excuse me while I look off here for just a second. You can see we expect that that margins will come under pressure without credits due to rising feedstock costs. Even with credits, we expect something pretty similar. The other key factor in that obviously is the value of energy, the value of renewable diesel and biodiesel, and we've seen quite a recovery in energy prices over the last 10 days, I guess, let's call it, with crude oil prices trading back up towards $110 a barrel. We saw biodiesel prices rise last week up just a touch. With the credits, they went from $7.25 a gallon to $7.35 a gallon. Conversely, renewable diesel dropped from $3.72 to $3.31 in the California market, at least in the prices that we quote, and that explains the difference in the moves in profitability there. All right, on to our RIN price forecast. So this week, our RIN price forecast changed a little bit. We lowered our RIN price forecast and we tightened the spreads up just a little bit. The lower RIN price forecast is really driven by weakness in D6 RINs. D6 RINs started to recover and then they haven't really come back as much as or as quickly as we thought they would. That's due in part to the sort of rumors that the Biden administration might do something about the renewable volume obligations to reduce the cost of compliance with the RFS mandates. There hasn't really been anything more than rumors on that, but it does seem to be impacting at least the D6 RIN market. And so the reduction in our D6 RIN price forecast lowered our D4 forecast. And then given that D6 was already lower, we tightened the spread up a little bit and that lowered our D4 forecast further. Now, I think in practice, probably what you're going to see is that if that is the right way to go, if the spread is going to tighten up further, then that actually will imply higher RIN values for both D6 and D4 than we project right now, or at least that will increase the upside risk for RIN prices. But right now we've got to deal with the prices that we're currently seeing in the market, and what we're seeing is weakness in D6, and so that kind of brings the whole well, that brings the price for both of them down a little bit lower. Again, this all sort of gets back to this question of whether there will be enough ethanol production to meet the ethanol mandate. And if there isn't, we would expect that the price risk for the spreads, again, is probably narrower, and the price risk for RINs is probably higher. Our LCFS credit price forecast didn't really change. You can see that the LCFS credit prices remain in a downtrend, and we still expect them to continue to move lower, at least until we get through 2022. And then in 2023, there's a chance for them to move higher, at least based on the forecast that we did that were driven by the last update from CARB in January, I guess. And the projected credits and deficits for 2022, it looks like credits surge in 2022 as more renewable diesel production comes online, and are actually above deficit generation. That's why you get the pressure on prices. But we expect that they probably even back out in 2023 as credit generation gets harder and deficit generation gets easier. As they level back out, then that's where we expect prices to find a bottom and then maybe start to move higher. Maybe they'll just sort of trade along at that value, and that'll be the equilibrium. But we would expect them to probably start to move back a little bit higher starting in 2023. All right. That is really all I have today. If nobody has any questions, I'll get everybody out of here early this week. And like I said, next week we'll have something a little different. I'll do a little presentation, so you won't just have to listen to me babble. I'll actually have some different charts for you to look at. And we'll talk next week. We'll focus a little bit more. My talk will actually be more about the soybean market relative to soybean oil, because obviously the price of soybeans impacts the price of soybean oil pretty significantly. And what I'm going to do is sort of lay out the most bullish case for soybeans that I can come up with, to give you some sense of what the upside price risk for soybeans and potentially for soybean oil looks like over the summer. And then, like I said, we'll have David Becker on, and he will talk about some tools that we have to help you mitigate that risk. All right. Thanks everybody for attending. I hope you all have a good rest of your week, and I hope to see you back here next Tuesday.